Hello friends and welcome to StudyIQ. I am Joycey Joy and today we will be discussing about the fifth bi-monthly policy of the RBI. So yesterday RBI has given its fifth bi-monthly policy review and certain decisions were taken. So we will be discussing about the fifth bi-monthly policy review of the MPC, that is the Monetary Policy Committee headed by the Governor of RBI. Very important from your examination perspective, not only from UPSC perspective but from all other competitive examination perspective. This is a very important lecture. So let us first come to the current affair. Let us see what is the current affair. So here recently the policy review was held and this was done by the MPC. Now, we know that whenever there is some problem in the economy, policies are required. So this policy can take two forms. One is monetary policy or monetary policy. Second one is the fiscal policy. So monetary policy is the responsibility of the central bank. So in case of India, it is the RBI. Now fiscal policy is the responsibility of the central government. Now monetary policy is taken by the RBI and it is taken by MPC. MPC is the monetary policy head of the country. So MPC is Monetary Policy Committee which has members from RBI and the central government. 3 each, 3 from RBI and 3 from central government. So the chairman of this Monetary Policy Committee is the governor of the RBI itself. So the monetary policy is taken by the MPC. Now the governor of RBI, being the chairman, he has a casting vote. That is, in case of a tie, then the RBI's governor can use this capacity to give an extra vote. So this means that RBI has an upper hand over the MPC, the decisions taken by the MPC. Now, the policy review. When we talk about policy review, it is the monetary policy review. So the monetary policy review was held recently and certain decisions were taken. So this is the current affair. Now let us come to the most important highlights of the monetary policy review of the RBI recently. First one is that RBI, that is the Monetary Policy Committee, has adopted an accommodative stance. Now what is meant by an accommodative stance? Monetary policy can be broadly divided into two. One is expansionary monetary policy and the second one is contractionary monetary policy. So these are the two broad classifications of monetary policy. Now, expansionary monetary policy means that RBI will adopt a policy where it tries to increase the money supply. And contractionary means RBI will try to reduce the money supply. And in between expansionary and contractionary is the accommodative stance. So accommodative stance means that RBI want to increase the liquidity in the market or the money supply in the market, but it is nowhere trying to expand it to a larger extent, nor it is trying to contract. So in between is the accommodative stance, and now the governor of RBI has said that it is adopting an accommodative stance. That means it is trying to infuse some liquidity into the market but not adopting as such expansionary policy. So this is the first thing. Second one is that the repo rate has been kept unchanged. Now why is repo rate very important? So for that we need to understand the mechanism of monetary policy which impacts the money supply in the market. Now repo rate is considered as the benchmark interest rate in a market. So being the benchmark interest rate, it has the capacity to increase and reduce the money supply in a particular market. Now let us see how does this happen. So when the RBI increases the repo rate, it means that the cost of borrowing for the commercial bank is high. Why? Because repo rate is basically the interest that is charged by the RBI from the commercial banks when the commercial banks buy loans from the RBI for a short period of time. So this is the interest rate for commercial banks. So when there is a high repo rate in the economy, it means that the commercial banks will have to pay high interest rates to borrow from RBI. So definitely the cost of borrowings of the commercial banks will increase. Therefore, the commercial banks will charge high interest from its customers as well. So in market what happens? The general interest rate increases. So when interest rate increases, the loans or the money supply will come down or the credit creation will come down. So this means money supply will come down. So when there is an increase in repo rate, this means money supply will come down. Now let us take the second case where RBI reduces the repo rate. So commercial banks, they can borrow money from RBI at a lower rate of interest. That means the cost of borrowing of the commercial banks will come down. So what does it mean? It means that now the banks will be able to provide loans to the customers at lesser rates of interest. So definitely the money supply will increase. So decrease in the repo rate means there is an increase in money supply. Now the repo rate has been kept unchanged. You have to remember here that for the 4 consecutive times in the past, the Monetary Policy Committee has intentionally reduced the repo rate. So they were trying to expand the money supply, and now the repo rate is kept unchanged. It means that the RBI does not want to bring down the money supply. So it is just taken a hold on the money supply issue. So here the repo rate is unchanged. That means the RBI is again adopting an accommodative stance. Now, third very important highlight of this meeting, it is that the RBI has decided that the GDP growth forecast will be reduced. So, if you remember, in the beginning of this financial year, RBI predicted or forecasted a GDP growth rate of 6.9% for Indian economy in the year 2019-20. Again, in the last policy review, it reduced it to 6.1%. Now, there is a sharp decline or the deceleration in the GDP growth forecast by RBI. It is now 5%. Now, why? What would be the reason? The reason is that now we have the data for Q1, the quarter 1 and quarter 2 for this particular financial year, and the quarter 1 GDP growth rate is just 5% and the quarter 2 is just 4.5%. So there is a sharp decline in the GDP growth rate. So that is the reason RBI has reduced its GDP growth forecast in India for the financial year 2019-20 to 5%. So these are the most important highlights of the meeting. Now moving on, let us see what is policy repo rate. So the policy repo rate, as we said, repo rate is a benchmark interest rate, and repo rate plays a very crucial role in determining the interest rates in the economy. So now at present the policy repo rate is 5.15%. It is unchanged. So from the last meeting, RBI has not changed the interest rate, so it is kept unchanged. Whereas the 5.15% repo rate of interest, this is the 9-year low interest rate in the economy. So even though this time RBI did not bring down the interest rate, this is again the 9-year low rate of interest in the economy. And we have already seen that how the interest rate, the repo rate will impact the money supply. So when there is an increase in the repo rate, this means money supply will come down, and when there is a reduction in the repo rate, this means money supply will increase in the economy. So this is the relationship. Now moving on, let us come to the decision taken on digital currency. So in this particular MPC meeting, Monetary Policy Committee meeting, RBI Governor, the chairman of the MPC, made it very clear that RBI is against any kind of private digital currency, whether it is cryptocurrency or any kind of private digital currency. RBI is against it, and the reason is that currency is a sovereign function. So that's why it is against it. And also the Apex Bank, the RBI, made it clear that RBI has already started discussions for the launch of its own digital currency, that is a sovereign digital currency backed up by the government, backed up by the monetary authority RBI. So discussions are already begun for the launch of its own digital currency, and the chairman of the Monetary Policy Committee, the governor of RBI, made it clear that RBI is definitely looking into every possibility of launching its own digital currency. So this is again about the digital currency. Now about the fiscal deficit, very important. RBI made very important comments on the fiscal deficit. So the RBI, the Monetary Policy Committee, said that it is not worried about the fiscal deficit. So we need to know what is fiscal deficit and what are the factors that can influence the fiscal deficit of the government. Now fiscal deficit, it is basically the excess of budgetary expenditure over the revenue of the government. So when the expenditure of the government increases over its revenue, definitely government will have to borrow money in order to meet this deficit. So this borrowings is called fiscal deficit. So fiscal deficit is basically the amount of money that needs to be borrowed by the government in order to meet its fiscal deficit or its deficit. So this is fiscal deficit, and the RBI governor made it very clear that he is not concerned about the fiscal deficit at this point of time. So what makes it important for us to understand this is the budgetary target. The government in its latest budget, in the 2019-20 budget, made it clear that the fiscal deficit target of the government is at 3.3% of GDP. Let us come back to fiscal deficit again. So as I said, it's the excess of expenditure over the revenue. So how can you reduce the fiscal deficit? Either two things have to happen. First thing is to reduce the expenditure, or secondly you have to increase your revenue. Now, why there is a dilemma now? The reason is that for the government at this juncture where the economy is going through a slowdown, the revenue collection of the government is very low, especially the tax revenues. This is because the income of the individuals have come down. There is unemployment, so income levels have come down. Again, for the corporates, the profit margins have come down. So corporate profit comes down means the corporate tax collected by the government will come down. Again, demand created in the economy. So demand created in the economy is very less, which means that the households are demanding less goods. So GST or the indirect tax revenue collection will also come down. So the government is actually witnessing a revenue shortfall. Now, what can be done with the expenditure part? So during the period of an economic slowdown, according to Keynesian theory, what the government need to do is to inject money into the economy. So government has to do it by increasing the expenditure of the government through investments. So public investment or government expenditure is very much important, and this is how the situation can be solved. So there are no possibilities that the government can increase its revenue or can cut down the expenditure. Rather, the government needs to increase its expenditure. So this is why we are concerned about the fiscal deficit target, whether the government will be able to meet its fiscal deficit target of 3.3%. Whereas RBI has made it clear that the RBI is not concerned or it's not worried about the fiscal deficit target. It is sure that the government is going to meet the fiscal deficit target. So one possible way would be to increase the disinvestments, which we will talk about in a different lecture, because disinvestment is a fiscal policy and there is no scope for talking about disinvestment in the monetary policy. And the RBI has also suggested that counter-cyclical fiscal measures. This is what is required in order to bring back the economy back on track, especially with regard to the fiscal deficit. So this is the comment given by RBI with regard to fiscal deficit. Now let us come to the other important highlights of this MPC meeting. Let us see what were the other highlights of this meeting. First one, we have seen that recently there was an NBFC crisis. There was then a liquidity crisis in the NBFC sector. So RBI made it clear that no NBFC will be allowed to collapse. So for that, the RBI said that it is going to increase the level of monitoring in the NBFCs. So RBI will monitor the NBFCs closely so that they will not again go into a collapse. So remember what happened with ILNFS. ILNFS was an NBFC, and with the crisis in the ILNFS NBFC, the NBFC sector crisis itself started and there was a lack of liquidity in the NBFC sector. So RBI made it clear that it is going to put a check on the NBFC performance, which will cut down the scope of any collapse on any NBFCs. Second one, RBI also assured that it will be taking measures to increase the credit flow. Credit flow in the sense that it will ensure that the money supply in the economy increases. So when money supply increases, the investments increases, also the consumption increases. So this will create demand and also supply, that is output generation. Now again, thirdly, about the monetary policy transmission. Now what is meant by monetary policy transmission? We have seen that when the repo rate is reduced, what should happen? The commercial banks would be receiving the loans from RBI at a lower rates of interest. So scheduled commercial banks, they in turn, they should be able to provide finance or credit to the public at low rates of interest. So this is called monetary policy transmission. So when RBI cuts down the repo rate, then the customers or the general public should be able to get loans at cheaper rates of interest. So if this happens, this is called monetary policy transmission, and the RBI said that the monetary policy transmission during this period was reasonably swift. That means it was reasonably well and good, and it took place at a faster pace. So this is the comment regarding monetary policy transmission. Now other highlights. Now RBI is expecting a core inflation in the next few months. This is because of the steep increase in the telecom tariff. You have seen that recently in the news, it was covered that the telecom sector has increased the tariffs on your mobile phone usage, so the tariff has increased. So this can lead to a core inflation. Now what is meant by core inflation? Core inflation is the general inflation which excludes fuel and food. This is because food and fuel are highly volatile. So when we reduce or when we eliminate fuel and food inflation from the general inflation, we get the core inflation. So it is expected that the core inflation can increase in the coming months, and the primary reason for that is the increase or a steep increase in the tariff of the telecoms. It also mentioned that both RBI and the government is working in coordination and cooperation with each other to contain this economic slowdown. So government will be responsible for making fiscal policy and RBI for monetary policy. So both fiscal and monetary policies will be taken together in coordination with the RBI and the government. That is what RBI has decided and has conveyed. Now the inflation expectations. The inflation expectations are moderate for RBI, and also it has noticed that the economic activity has weakened. That is, the output generation in the economy has weakened. So these are all some of the important highlights of the MPC meeting, and we have to wait and see what happens, and we are also waiting for the Quarter 3 GDP estimates as well, and very soon in the month of February the budget will give us a very clear picture about all these things. So we should closely watch and what happens in the economy, and you can find the PDF of this lecture on our website www.studyiq.com. You can follow my Facebook page for more video updates. You can write to me at joycey.studyiq@gmail.com for any of your queries and clarification. Thank you.